Hello, class, and welcome to our sixth lecture series on financial accounting or principle of accounting. And I'm your instructor, Jamal. Hi there. So I'm just going to be making a breakout room, and this is a collaborative or group work. All you have to do, you have to make a closing entry. So they're going to be like here, uh, many transactions which you need to close down in adjusting entry. So let me just make a breakout room, and then I'm going to be sharing the questions in the group. Okay, so I'm just going to pause the video right now here so that you guys have like 15 minutes time to do that, and then I'm going to resume this recording. Okay guys, welcome back after the breakout rooms. I hope you already finished these entries. So let's see the solution. So if you have any query, please confirm here that whether you did right or wrong. And if you still have any question, please raise your hand and raise your voice, and I can repeat this entry as well. So let me repeat the question. Phonics Equipment Rentals Company face the following situations. Generalize the adjusting entry needed at December 31st, 2014. So remember, whenever there is adjusting entry, you would see the closing of the year or financial year or fiscal year, right? So for each situation, let's make the adjusting entry. Number one, the business has interest expense of 1200 and that it must pay early in January 2015. And you are where? December 31st, 2014, right? But you have to pay in January. But date is not mentioned. It means interest expense occurred, but you didn't pay. It means you create payable liability. Very nice, Indra. So what is the entry here then? Interest expense to interest payable, right? Any question regarding this entry? Everyone did right?
Yes.
Very nice. The second one, the unadjusted balance of supplies account is 3200. The total cost of the supplies on hand 1500. What does it mean?
$1,700 is used.
How much we used?
1,700
minus 1500, because 1500 is their closing balance, right? So you can just find out that 1700, right? 3200, which is the balance at the start minus balance at the end. 1700 we consume. So what is the entry?
Supply expense to supplies.
Very nice, because supplies account is our asset account, and 1700 we used or we consumed. That is our expense, right? And whenever we want to shift the amount to this amount to the expense, so we see the relevant account. So this belongs to supplies, so we create supply expense. Let me just. So the entry would be supplies expense to supplies. So if you have a question why there is two types of supplies here, so because one is supply expense, that is income statement item, and this is our asset which belongs to balance sheet. Understand? So this is our expense, this is our asset. And why supplies are credit? Because asset decrease, credit. Expense increase, debit. That's why our entry is supply expense to supplies. Third, salary expense is 7,000 per day, Monday through Friday, right? And the business pays employees each Friday. This year, December 31st falls on Wednesday. What does it mean? Wednesday, Thursday, and then Friday. right? It will be, this would be like 1st of January, this would be 2nd of January, right? It means salary would be paid on 2nd of January, but we need to close. So it means how many salaries we have to pay?
21,000.
Tuesday, Wednesday salaries, because these two salaries still not earned. Understand? At this time, 31st of December, the workers didn't work for these 2 days. These are future days, right?
Yeah.
And how much salary is payable?
21,000.
3 days. Understand? So pay very close. This is not a rocket science here. Just you need to pay attention and very keen attention on the dates, and you find out the days. It means on 31st of December, how much salary is due, and what is now the entry would be. This is due but not paid. Means we create liability, payable. So what is the entry?
Salary expense to salary payable.
Very nice. Understand? Anyone who has question, who don't understand this? So this is expense will go to, this is liability, liability will go to,
Balance sheet.
so expense increase, debit, liability increase, credit. So the entry would be salary expense to salary payable.
So I have a question. Why don't we put salary expense as the full amount and then the payable?
Because we are on 31st of December.
Or do they not get paid on the 2nd, or do they get paid on the
Yes.
31st?
The amount will be paid on, but that belongs to second accounting year, the next accounting year. This accounting year will be closed on 31st of December, right?
Total expense,
So
wouldn't it be
financial statements are made at the end of financial year. So we have to present the financial statements for the end of the year. We don't include the next year data or next year expenses or income into our current journal, ledger, or income statement, or financial statements, other financial statement like balance sheet, retained earnings, right? So we have to show the data which belongs to in appropriate dates, 1st January to December 31st. That's it.
Okay.
So we will pay them on Friday, the 2nd of July next year. But this year contribution is till 31st, right? So how much accrue? Accrued expenses would be 3 days. Yes.
So when it's time to record like the next transaction, when they do get paid on Friday the 2nd,
Yes.
how
When
is that?
then it would be like again on Friday, the entry would be, let me, we have it here. Here. So on Wednesday, the balance was, which is liability, salaries payable. So now on till Friday, when there is a payday, what would be the entry? You pay to the workers 5 days. Entry would be that you pay cash going to be decreased. It means cash going to be credit 35,000, right?
And expense
Right.
debited.
So salary expense going to be
debited 35,000.
salary expense going to be, because we already created, what was the entry before? Salary expense to salary payable, right? 21,000, right?
It's going to be salary expense to cash.
So this time the salary expense going to be, because this was the previous year, it's already accumulated, it already gone to the income statement of previous year, right? So we are not getting this because this is already closed. We will take this because this will go to the balance sheet, and this we would take that salary expense on 2 days, 14,000, and this we make a reverse entry because this is payable. Now this is paid. Decrease of liability is debited, salary payable, and to cash, 35,000. So this entry, when you add it 35,000, this 35,000 debit is equal to credit. This would be the entry. Understand? Because we cannot use the previous year expense to this year, right? This year expense is to 2 days, 14,000. But we paid 35,000. It means this comes from balance sheet, because this item would go to balance sheet and it will be shown in next year balance sheet as well at the start of the year, right? And this will go to income statement and we consume that. We showed that this will be our profit. Profit go to the retained earning, and retained earning go to the balance sheet, and it's like that. So statements are done. That's it. So we have to use matching principle. What are the matching principle? Revenue recognition principle and expense recognition principle. It means expense are recorded when they occurred into that period. That's it. We cannot take expense to the next level or previous level. So you got my point?
Yes, thank you.
Okay, next entry. On July 1st, 2014, when the business collected 15,000 rent in advance. Rent in advance. It means at that time, we make an entry. What would be the entry? This entry.
Unearned revenue.
July 1st. July 1st. What was the entry when we paid prepaid rent? We paid. It means cash decrease. Cash would be credited 15,000. And this is expense? No, because this is prepaid advance. So that is our asset. We call that prepaid rent or rented advance. You can also say that 15,000. That would be our entry at the start of, right? But now what happened? Oh, sorry.